Good afternoon, everyone, and thanks for being here. I'm Doug Skinner. I'm part of the business intelligence team here at AFS. And before we get into the product demo, I want to take a few minutes to kind of set the stage, not just for what you're going to see today, but for why we build it and where it fits in what we're doing at AFS more broadly. So what we've enabled in the pricing dashboard is predictive market-informed pricing intelligence. It's going to give your bankers a kind of a defensible range of pricing that's grounded in both historical data and current market conditions. And you'll see we've also made it API enabled, so it's kind of portable, and we can then integrate it with any other tools or that you have or databases that you use. Stepping back for a minute, this release is also part of a deliberate AI strategy we're building across the company. We've made a conscious decision to that AFS has to be embedded in a transparent and credible way. So in this case, it's grounded in real data, and importantly, it's explainable to the people that are using it. So everything we're doing in the AI space is going to be oriented around that principle. So that foundation is going to be critical for our use of AI, for it to be useful and not just interesting. So what you're seeing today with the pricing dashboard specifically is us starting to execute on that strategy. So just a few housekeeping items before we jump into the webinar. The session is being recorded, and we'll send it to all the registrants following the webinar. If you have any questions, please feel free to ask them using the, I think you could use either the Q&A or the chat icon at the top of the screen, and we'll certainly try to answer all the questions, but if we don't, we'll respond via email or something like that after the call. So it's now my great pleasure to introduce Jeremy Charlson. Jeremy is a senior business analyst in our BI department. He works primarily with regional banks supporting their pricing analytics and reporting needs. I think if you've listened to Jeremy before, he's a real expert in the industry when it comes to credit risk and loan pricing practices in commercial banking. So I know many of you already know Jeremy and have been on his calls, so I'm sure you'll enjoy his comments over the next half an hour or so. So Jeremy, I'll turn it over to you.
Well, thank you, Doug, and appreciate everybody taking some time today to really get to see what we're doing with AI and how we're using it to improve commercial loan pricing. Our goal here at AFS is to deliver products and services that meet the needs of banks today. And we know that expectations are changing, the market is changing, and that commercial loan pricing today really requires a modern solution. So to that end, our goal in this presentation is to illustrate our latest use of AI to provide forward-looking, market-based pricing guidance. I know it's a bit of a mouthful, but it'll become a lot more tangible and clear as we go through the presentation. As Doug said, the AI that you see here, it is not an abstract concept. It was built for banks with a specific goal in mind, and it's something deployed today in our pricing dashboard, our pricing service. So for today's agenda, we will keep it relatively brief. We want to be respectful of your time, but we'll give you really just a succinct introduction to our AI model, why we built it, how it operates from a 10,000-foot view level, and then we'll actually show you the AI in action. I do want to have some time at the end as well to talk about ways in which we might be able to deploy this into other systems than the pricing dashboard, so into your own internal CRM system, into a future loan origination system. And I think there's a lot of exciting applications that we can share on that front. So as many of you know, AI is really only as good as the data that's fed into it. And for this pricing intelligence, for this AI model that we've built, our rocket fuel, so to speak, is the AFS Pricing Dashboard. Now, I know many of you are either clients that have the pricing dashboard or have seen some of these demonstrations before. So I won't go too much into the kind of blocking and tackling here. But what is important to note is that the pricing dashboard, it contains highly granular, longitudinal, and normalized pricing data. So that makes it a really great platform to uh, for machine learning, for advanced analytics, for regression analysis. It's really well suited for those purposes. More importantly, from a practical point of view, the nature of the data is such that we can model how aggressively or conservatively banks can price without losing the deal. And that's going to be the purpose of this model, is to give you a range of pricing options and show you the likelihood that you could win this deal based on price alone. This first iteration of the AI, it has been embedded in the pricing dashboard. It's live today. Our client banks are using it. And in the coming months, as Doug said, we're building an API framework so that we can deliver the intelligence outside the dashboard. And we're really excited about that. I think it'll enable us to integrate these benchmarks, these AI machine learning recommendations, really at the point of decision when you're originating loans and really throughout your CRM systems as well. And we'll have a more tangible example of that near the end of this presentation. Now, one of the things that our CEO here at AFS always advises us, and I really like, is that we should always build and deliver with the customer in mind. And leading up to the creation of this AI, we collected feedback from many of you on the call, many of our clients, really trying to understand what are your biggest pricing pain points. And from those discussions, there were four themes that emerged. The first is that there's a great deal of market volatility right now. In recent months, we're seeing pricing dispersion widen. We're seeing that across banks, across sectors, across geographic markets. Also seeing, and we've reported this in our pricing newsletters, a lot more frequent and larger risk and return anomalies, just more irrationality in pricing overall. The second is that there are certain sectors or geographies in the commercial loan market that may not have a lot of market depth. These could be sectors that banks are beginning to pivot towards, but right now there's not a lot of uptake with which to model a great or an appropriate price or spread. So it's really hard in these underserved segments to distinguish signal from noise in the marketplace. The third is that with pricing recommendations, they need to be more than a static single hurdle rate. Banks really want a range of outcomes. That's preferred for many reasons, one of which is that we know there's a lot of nuances when it comes to pricing for your borrowers, right? There's relationship factors, there's other kind of idiosyncratic things that we have to take into account. So rather than just having one price point, we try to provide now a range of outcomes. And finally, what you've all told us is that pricing recommendations, they need to be personalized, meaning they have to reflect more than just risk. They have to account for collateral, size, geographic nuances. So that way banks don't price themselves out of the market. So these pillars, this feedback from the clients, this was really the business and qualitative foundation for the AI pricing model that we built. So let's discuss now quantitatively what this AI actually is. So at its core, this is a supervised regression model, which is a fancy way of saying it's a super advanced form of pattern recognition. We map loan characteristics to pricing outcomes. Got a lot of complicated math behind that, but that in layman's terms is essentially how this model operates. So what we do, we consume in terms of inputs, historical loan data from the pricing dashboard. We look at um, all the ways in which pricing varies by risk, by collateral, and we train the model on that historical data. The learning process that we developed, the AI here, it's able to separate signal from noise. So that way we can really focus on the fundamental pricing relationships that we see across risk, across size, and try to minimize the impact, the adverse impact of some of these more extreme outliers. We then allow banks to input their deal criteria. So imagine, if you will, you're originating a loan or you're working on a renewal. You know the size, the risk grade, where the borrower is domiciled geographically. You provide those inputs to us, and we feed that into the model. The model then takes what it's learned about commercial loan pricing and it outputs a predicted interest rate. Now, when I say predicted here, I'm not talking about trying to predict the path of interest rates 1 year from now or trying to anticipate, say, the Fed's next move. It's predictive in the sense that it tells you how the market, how your peers would price a similar deal. And it's also predictive in the sense that it tells you, well, based on price alone, if you were to offer, say, 7% on this deal, just making that up, what is the likelihood that you'll win that deal? Or will you accidentally price yourself out of the market? Are you being too aggressive? It really helps you understand how conservatively or aggressively you can position each deal relative to market dynamics. And I want to mention too that we're in the process of building out an API delivery framework so that in the future, banks will enjoy a variety of ways to consume and embed this intelligence in their CRM framework. So with that brief overview, what I'm going to do now, bear with me one moment, I am going to actually show you now this AI in action. And as I mentioned, we had built this in the pricing dashboard database. I'm logging into that application now. This is not smoke and mirrors. This is something that has been delivered in production to our clients, and they're actively using it to really assess what's going on in the marketplace and what would be an appropriate price point for quite literally any combination of characteristics that I might originate or renew. So I'm going to share my screen again here. We can take a look at how that's playing out. And Doug or Renee, if you could just quickly confirm, can
Yep,
you
you're
now
good,
see?
Jeremy.
You're good? All right, perfect. So this is actually the AI in action. This is the UI that we built on top of it. And you can think of it kind of like a lookup page in which you can input different deal criteria, and our AI model will recommend an appropriate interest rate for that selection and give you some further insight into kind of what's driving pricing in that cross section. So imagine, if you will, that you are working on, let's say, a renewed loan. And let's say this is a CNI loan. It is tied to SOFR, and it is located in the West region. These are some generic geographic regions that we have in the dashboard, but I'm picking the West because I've been hearing a lot about California as of late. These are some of the most important pricing drivers that we've heard from all of you, geography, index, the risk rate of the borrower. And what's neat here is you don't have to invoke every selection. You can be as specific or as broad as you'd like in your selection. So if you're originating a deal right now and you don't know right now the risk grade, you don't have to select risk rating. You can ignore that parameter. The model can still, it can ignore that particular variable and still infer a predicted price. And with this AI model, with these regression analytics, we can determine an appropriate price point as well as a pricing range, a confidence interval, for quite literally every combination of these characteristics, every combination of line of business, of index, of geographic region. So if there's a segment right now, I mentioned that there are some industries or there are some geographies in which the uptake as of late has not been very robust. If there are, we don't see right now a lot of, for example, prime lending in the commercial real estate space. But if that is something you wanted to investigate, even if there's not a ton of activity behind that particular selection, our model can still infer, should this kind of loan type be offered in the marketplace, how would your peers price a similar deal? So with the selection that I have here, if you kind of focus your attention for a moment on this barometer chart, what the model estimates, the direct output of this model, is that interest rate at the top. And what this says is that for a CNI renewal in the West tied to SOFR in April, this would be typically how the market would price this loan, around 5.35%. Now, we know that there's always nuances when it comes to commercial loan pricing, right? There's always going to be some volatility in the marketplace. There's also relationship factors and just other criteria that may justify a higher or lower rate than this one single hurdle rate. And so what we do in this barometer is we give you a confidence band that really reflects, if you're within this between 3% here and 7%, you're still pricing appropriately relative to risk, to size, to whatever parameters you had selected. What I really like about this range, one kind of practical way to interpret it is that it can illustrate the likelihood that you would win the deal based on interest rate alone. So let's say you were pricing for this particular loan type more on the low end of the spectrum, so closer to that 3.7% that you see illustrated here. That represents or equates to about a 90% chance that you would win the deal. In other words, because you're offering a rate that is so much lower than the median average that we have there at the top, your likelihood of winning this deal, of attracting the borrower by discounting price, increases significantly. So you have about a 90% chance of winning the deal on the low end here. And conversely, if you're pricing more towards this upper end, the likelihood that you win the deal can drop down to 10%. So it helps you see not only how aggressively and conservatively you can position the price of that deal, but if you want to, let's say, expand in the West region, you're trying to break into the California market, this shows you the tolerance range or the barometer um, through which you might want to. It allows you to kind of calibrate your pricing to figure out if I want to book more volume, how low do I have to go to really win that deal? And then elsewhere in this report, if you look at this table at the bottom here, we actually break out how the modeled rate is derived. So how your individual selections contribute, in this case, to this 5.35% interest rate. And for those of you that are versed in regression vernacular, these are the model's betas or coefficients. And in layman's terms, they represent the individual effects of each variable. So this, for example, says for geography, when you normalize for things like risk rating and size and index, even when you take into account differences in mix across geographic regions, a loan in the West, which is our selection here, tends to be priced 22 basis points beneath the national average. So if you're trying to really disentangle the drivers of pricing, or throughout your footprint, if you're trying to determine, well, which regions really are more competitive than others, once you account for and normalize for differences in industry and risk mix, it can give you some really clear insight into which areas of the country, which sectors in the market are just inherently more competitive or less competitive than others. So for acquisitive banks or banks looking to expand their footprint, this can be a really valuable tool to better understand your markets. Now, as Doug said, we're really excited about not only how this AI helps improve commercial loan pricing and helps improve and elevate the pricing dashboard, but we're also excited about ways in which we can integrate this intelligence with other bank systems and other agents at the banks. And what I'd like to show you now, this is a what you might consider to be a low density prototype, but it does illustrate the power of this pricing intelligence. I'm just going to zoom my screen here real quick. There we go. And again, Doug, can you just give me a quick verification? You can see the
Yep,
LOS.
you're good.
Awesome. So one of the ways that we might be able to envision how this data could play out in other bank systems and really kind of elevate a bank's entire pricing process is, what if we could embed this within your origination framework? So here we have a sample pipeline. This is not an actual bank. It's demo data, but the pricing intelligence is real and it is coming from that same AI that we saw in the pricing dashboard. So just to kind of orient you on this screen, this is showing you a sample pipeline. You can see various customers here, where they are in the origination stage, some of their indicative characteristics. But what's really cool is that next to the bank's interest rate, you can see from our model the rate that we're predicting for this particular customer. So our model is saying that for a loan of this line of business and risk grade and size and so forth, this is what we believe is an appropriate rate based on the model that the AI model that we trained. And for every loan, you can see whether or not under this residual column, you are higher or lower than our prediction. We can then roll up the results here to say, well, on average, does this bank, this sample bank here, do they price relatively close to the AFS prediction? Do they have a bias in one direction or another? And in this case, this red font tells us that this particular bank has a slight negative bias in which they tend to price a little bit lower than the rates that the AFS AI is recommending. It's not a huge bias, but there's a little bit of a negative skew there. You can see on these charts at the bottom kind of where that is taking place in the origination structure. So in this case, the scatter plot here is showing you If you are in the green section of this scatter, those are pipeline deals in which you're pricing above the AFS prediction. And then conversely, if you're beneath that 45-degree line, those are loans in which you're pricing beneath, you're not getting quite as much as you could be relative to what our AI would suggest. And you can kind of see how that plays out in terms of opportunity here, meaning if you could address all of the underpriced loans in your pipeline, what would that mean in terms of dollar benefit across your portfolio? I think this takes into more meaning when you can actually drill into an individual client. So I'm going to open up this particular borrower here, Helix Diagnostics. Again, it's a sample borrower. I'm going to open that up, and what you can see here is now some pricing information, some deal criteria just for that borrower, but more importantly, kind of factoring in the AFS pricing intelligence, where we're showing you for this borrower what recommended rate our AI is producing and where your rate falls along kind of a continuum of rates from our AI model. So in this case, we're saying, well, given what we're seeing in the market, given what we've seen historically for borrowers of this type, we feel that a 6.8% rate is appropriate. This particular bank is pricing well on the low end of that pricing, that confidence band that our AI generates. That's a pretty meaningful difference. The difference in rate here equates to a lifetime loss in terms of interest income of over $200,000. So it can really quantify what that opportunity is of under or overpricing. We can then get some additional analytics on that customer where we can say, well, okay, well, one good thing about pricing beneath the AFS prediction is that you're likely to win that deal. You're likely to outbid your competing banks. And in this case, what the AI generates, it's saying that because you're pricing so much lower than the prediction, the AFS prediction, you have about a 97% chance of winning this deal, again, just based on price alone. So there's a trade-off there. And our goal here is not to ever dictate pricing policy to you. We don't want, I mean, you know your customers best. It's more just to give you all the information, all the analytics, and all the context you need to really make an informed pricing decision. Long term, where we'd like to kind of see this AI go, I know a lot of you probably receive our pricing newsletters. You may have joined us for our quarterly pricing updates, where we look at kind of trends in the marketplace for C&I and CRE loans. Qualitatively, we can integrate a lot of that research into the AI as well. So not just kind of a mathematical formula behind the AI, but actually incorporating what we're hearing from you, what we're seeing in the marketplace in terms of different industries that are growing and how that's having a bearing on pricing. And this text down here, this is not smoke and mirrors. This is actually trained on our pricing newsletters and webinars, and it's trying to give you some more context for why we estimated, or the AI model estimated the interest rate that it did. So it talks about collateral, it talks about some industry dynamics. So for example, this is a healthcare borrower, and we are seeing spreads in that sector widen over time. That's why we, in this case, estimated a comparatively higher rate than the bank. So it really gives you some super great analytics into what's driving our prediction, what we're seeing in the market. Again, not telling you what to do, but just giving you the context to make a more informed decision. And if you wanted to improve the profitability of this loan, if for some reason you couldn't get a higher rate or you couldn't reach the rate that the AI at AFS is recommending, there are other actions you could take to lift the overall ROE on this loan. Okay. So I'm just going to circle back here to our PowerPoint. So I wanted to keep this presentation today brief. I know this is a lot to take in, but we are very excited about the ways in which this AI can really help transform commercial loan pricing, the ways in which it can really give you some additional context to understand market dynamics, and again, just really improve pricing decisions overall. And at AFS, we are always looking for new ways to improve our products and services, really stay cutting edge. As Doug said, this is part of a broader AI strategy here at the company. We really look forward to collaborating with all of you and continuing to grow and find new ways to make pricing, commercial loan pricing, a little bit more exciting and a little bit easier for all of us. So Doug and Renee, with that, I'm going to pause here and give anyone on the call a chance to ask questions about this model or our pricing or just anything else that's on their mind.
Thanks, Jeremy. That was great. We do have a few minutes. If you do have any questions, uh, please go ahead and post them in the Q&A chat at the top there. Jeremy, we did have one come in earlier. It's around the model itself, and it's how often is the underlying regression model itself retrained or recalibrated, and where does that responsibility lie, I guess? Is it with AFS or the bank?
Sure, those are both good questions. So for the first one, the model is retrained monthly, so we always want to capture the most recent pricing dynamics in the model. Uh, this might get a little bit technical, but long term, we're looking at ways to monitor model drift and data drift and use techniques like gradient descent to really just make sure that over time, the model becomes much more refined at separating signal from noise and really understanding, well, how does price correlate with risk and size and so forth? But it is retrained monthly and it does become more accurate and precise at identifying those patterns, the more data and the more iterations that it takes over the next few months. AFS right now is responsible for that governance. We're refreshing that model using our pricing dashboard database. So that program, that pricing dashboard program, that's refreshed every month. And the new deal flow that comes through that becomes the new training data for the model. Long term, I'd love to incorporate some of the bank's pricing guidance and rules into that model. That's probably version 2.0. But right now, it is retrained monthly on AFS market data, and we're in charge of that governance.
Great. Another question. How representative is the data for banks focused heavily on specific niches, say agriculture or healthcare or construction, where deal flow might be thinner?
Yeah, this is an awesome question, and this is one of the beautiful things about machine learning and regression analysis is that the way the model operates, it's looking at the effect of industry on pricing and risk on pricing and so forth one at a time, and then it combines those effects at the end. So the reason that's important is that, and this is my colleague Tom, who retired, always like to use this example. When you talk about kind of niche industries, let's say you had a pig farming loan in Alaska, just making that example up. Probably not a lot of actual deal flow in that cross section. Because our model understands how animal production correlates with pricing, and because it understands how pricing correlates with Alaska or different geographic areas in the country, we can combine those individual effects to predict, well, should a pig farming loan actually happen in Alaska? How would the market assimilate that deal and how would it price it? So if there are niche industries that right now don't have a lot of deal flow, or if there's combinations of characteristics that are a bit unusual, again, like seeing an investment grade prime deal in commercial real estate, that's theoretically possible, just not a lot of actual uptake. The model can still infer, well, should this loan type be offered in today's loan marketplace? How would your peers assess the pricing and the risk of that particular loan? So we are not constrained in this case by deal flow. For any combination of sector, risk, geography, and so forth, we can estimate a price point for quite literally any combination.
Great. I know we're at the bottom of the hour. I want to try to squeeze in one more if I can, Jeremy.
Sure.
Uh, this is about revenue lift, revenue impact. Banks are in a real tight budget environment. What's the typical payback period and the ROI? How should we think about that?
Sure. And because of we wanted to keep this brief, I didn't go into this in detail, but we do actually have a slide here, and this will be in the deck that gets sent out that does try to illustrate the ROE, so to speak, or the return on investment of this AI and these pricing intelligence. And one way that we like to kind of organize the data, so we just have a simple example here on the left where let's say for all of your loans, we compared the rate that your bank is charging to the AFS prediction. And let's say we focused on all of the loans where the bank rate was trending beneath the AFS prediction. That represents an opportunity in price. And if we take into account the loan volume, we can measure, well, should you be able to raise your price to the AFS prediction? What's the lift in annual interest income that you would realize? Again, knowing that it's not possible for all the loans, not trying to dictate pricing policy, but if you could address, let's say, the 10 biggest opportunities in your portfolio, the 10 biggest loans where the difference between the AFS AI prediction and your rate was the most pronounced, that can be a lift of tens of millions of dollars in annual interest income, at least for the sample bank here that we illustrated, which is an actual pricing dashboard client. So the experience will vary depending on the size of your book and how frequently it turns over and your industry mix. But even if you could use this AI to address a handful of opportunities in your book, that could more than justify the return on the pricing dashboard and the AI. The AI is included in a pricing dashboard subscription. So it does have a lot of power. Again, it's not meant to tell you you have to get this rate, but illustrate where those opportunities lie. And the banks that really focus on trying to close that gap even a little bit can realize millions of dollars in annual recurring revenue gains.
That's great. Thanks, Jeremy. All right. I want to again thank everyone for taking the time attending the program today. Jeremy, thank you for your comments. As I said,
Sure.
this is being recorded. We'll get the recording out as well as the any of the other related PowerPoint materials. I did see a couple of other chat comments come in that will follow
Sure.
up, outside of this program. But
Not a
again,
problem.
thanks to everyone and enjoy the rest of your day. Thank you.
Thank you, everyone. Appreciate the time.